Welcome to the Dividend Talk podcast, episode 225. Our approach to managing and growing our dividend portfolios. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJI. How are you?
I am bloody tired. I had so much going on this week. It's unbelievable. I hardly had sleep. My son was on a trip, so I had to wake up at 3 a.m. in the morning to drop him. And then later on the next night, I had to wake up at 4 o'clock to pick him up again. And, some parties. So it has been crazy. And I must confirm I'm quite... wasted, but hey, tomorrow is Monday again because we're recording this on Sunday evening. So tomorrow I will be full of energy again. Usually it's a I don't know, mindset switch, whatever it is, but I'll get there.
Yes. We had our Christmas parties, and you can probably tell my voice is still a little bit, fragile. So, but we'll get through this. We'll be okay. Diageo, I'm doing my best. Christmas profits are up. I'm doing my best, yeah.
Nice.
But let's look at the news of the week. I know you looked at Broadcom and their earnings. What do you make of them?
Well, it's not like I really went deep into them, but I just wanted to share my appreciation here. We've often said like this is the one that we missed out on. Remember?
It's our own fault. Dividend John was on this podcast.
Yeah, he went really big into this. I believe he was from South Africa, so he must be counting his money now, nice with a coconut somewhere. But it's amazing what they've been doing, and this is a serial acquirer, right? So because what's so surprising always for me is like they had 5.6 billion in cash from operations and only 122 million in capex. Yeah, so it's they don't invest a lot, let's say, in that. They rather acquire businesses, and this was always something that I didn't like about Broadcom. And clearly I've been wrong there, because I always felt like they buy a company and then they are like leeches, right? Squeeze every little thing out of the business and don't really reinvest into it. But seemingly this way of creating a holding company is what they have been doing. Has been very fruitful for them, very successful for them. And it led to a share price that bumped up 25% again. But it's not just a share price, right, that we are really interested in. Yeah. Also, the dividend was hiked by, was it 11% again?
Yes.
So, 11.3%. So this company has been on fire. And for instance, just looking at the AI revenue, which grew by 220%. So, and we have seen that with the other AI semiconductors, but Broadcom is also officially one of those now, and it has been like mind blowing what they've been performing. I mean, only compliments to what this company has been doing over the last 10 years.
Yeah, I'm not surprised. I'm looking at their VMware integration, and I mean, we have a lot of VMware in what we do, and the prices went through the roof as soon as Broadcom took them over. Prices doubled, quadrupled. They just shut up, even to the extent where we're looking at alternatives now because it's getting too expensive. And I'm wondering if other companies are feeling the same way.
But that's their management style. That's what they do
Yeah,
everywhere. These are leeches. Yeah.
yeah,
But from a shareholder point of view, they are doing the right thing. Yeah. For user customers, maybe not so nice, but I guess they look for companies that they acquire that have kind of a lock-in that you just can't simply move away from because of the switching costs. So that's what they do really, really well, really, really well. So and
yeah,
then the cash flow is, I mean, man, the money is flushing against the walls there. It's unbelievable.
yeah, yeah. And look, we'll talk about dividend hikes later. We might as well mention Broadcom now. You said another 11%. That must be, I think they had a disappointing one last year, if I'm right. Was it 1 cent or something? But it's been double digits before that. If I
Yeah,
remember
well,
correctly.
we will be talking later about our strategy, and yeah, Broadcom would have had a nice position, could have had a nice position in there by now. But hey, that's how life goes, right? You win some, you lose some. Not everything goes as you expect. That's the hard thing also about stock picking, because that's what we're doing.
Yeah,
In our case, and yeah, this is where ETFs usually you get the best of all
exactly,
worlds. Yeah,
exactly.
but and because that's the thing, right? You can have 4 losers of 20%, but if there's only just one doubles, if you equally invest, you make up for all the losers. So that's the beauty of that. Yeah,
Exactly.
hey, just like this.
Yeah, it's not Pokemon. You can't catch them all. You have to leave some go. But Kroger and Albertsons have been in the news, and I believe there was a merger proposal in the US, and it was
This one is funny.
denied.
Yeah, the U.S. judge, they blocked the pending 25 billion merger. Yeah, just called an acquisition of Albertsons by Kroger. And because the FTC, let's say, said like, hey, this will be an issue for competition. Yeah, for in grocery, leading to higher prices. But then that was. I like what happens then, right? So imagine you're being acquired for 25 billion as a board of directors. You agree to that, to being acquired.
Yep.
Then the FTC steps in and the judge steps in. It's like, guys, anti-monopoly law, you can't. And then what happens? They filed a lawsuit against Kroger, saying that Kroger violated its contract. I mean, this is really capitalism at its finest, right? you screw them even more over there. Oh.
Yeah, I mean, look, we've spoke many times about some of the differences in Europe and the US, and obviously this is one of them. I mean, it's hard for me to understand how you can do that, but look, America is different gravy. But I don't know why 25 billion merger probably would have made sense actually when you look at the two companies. I don't know why America felt the need to step in there. Maybe they're becoming more like Europe and starting to regulate a bit more. Who knows?
Yeah, that would be quite funny, right? Yeah, no. Hey, look, I do assume that they have done their work. Yeah. We are not in America. It's a bit harder for us to judge there. So yeah, I just found it funny. Like, you get acquired and then you sue them back. I mean, if management will pull back from Kroger just because they felt like they had second thoughts, right? But here there was a judge intervening. So, but hey, Albertson's probably doing what's best for their shareholders again to get some money back from Kroger. So
yeah,
let it go, let it go.
Okay, dividend hikes. We've got a couple to go through. Abbott Laboratories increased it by 7.3%, which is a nice hike. Bristol Myers Squibb 3.3%. I'm not sure if you're happy or not with that. Broadcom, we mentioned 11%. Pfizer increased it by 2.4%. There's a company we don't speak about often, and it's Zoetis, ticker ZTS. They do it's like vets, animal medicine, and so on. So it's a really hyper growth company as well. Just a low dividend yield, but they had another 16% hike. WD-40, we love boring businesses. WD-40 had a 6.8% hike. Mondelez had a nice hike of 10%. And Realty Income had a massive 0.2% hike recently as well. But some nice hikes there.
Yeah, definitely. It's good to see that just before the end of the year, we get some Christmas presents. I mean, I understand Bristol Myers. They have some patent cliff coming up. At the same time, they're Was it Alzheimer? No, which one was it? Yeah, I think so. Drug approval looks promising. 3.3%. I'll take it. At a certain moment, if the cash flow comes in again, they can buy back a lot of shares and grow the dividends further. Also, let's not forget they have already a 5% dividend yield, so it's not too bad. Mondelez is of course interesting because there again takeover talks to take over Hershey, which I don't see happening. I mean, I'm not Nostradamus, yeah, so it can happen, but that would be so stupid from the Hershey Trust. And yeah, so very interesting. And realty income, yeah, this is a few times per year and it always makes me smile.
Yeah, exactly. So some nice hikes. I don't own any of those companies except realty income, so it doesn't impact my portfolio. Main topic of today was inspired by two questions, not one, two questions, and I'll call out the two questions just so our listeners are aware. But the first one is by Dario, and it was building up a portfolio from scratch. How important is it, in your opinion, buying stocks at a fair value at the beginning? Would you focus more on adding quality stocks, no matter what price or valuation? And then Tobias asked the question, do you have expectations around annual dividend growth for your whole portfolio? Is it a fixed percentage, inflation plus percentage, or something else? So those two questions inspired the podcast, and I'm quite curious about yours. Where do you stand on what, like, your strategy, how you manage it day to day? What are your long-term thoughts on it?
Yeah, let me start with that, and please remind me about those two questions because I've embedded them a little bit, but if they are not clearly called out, then let me know.
Yes.
So I would argue that 90% of my strategy evolves out of dividend growth investing in the purest form. Yeah. What is dividend growth investing for me? Those are buying shares in companies that are continuously growing their shares over time. Yeah, and that continue to do so, and that have the ability to continue to do so.
Yeah,
that's for me dividend growth investing. So what is not dividend growth investing for me is dividend investing. Dividend investing is for me something wider. Think about high yield stocks, but 1 year a little bit more they pay in dividends, and the other year a little bit lower. I have a few of them also in my portfolio. This is BHP and Rio Tinto. They typically pay dividends with how the cycle goes. Yeah. And then I also have a few non-dividend growth investment stocks, although maybe one became not too long ago one. That's, for instance, Google. I bought them really for the tech exposure at the time. Small percentage. Generally speaking, should not be more than nowadays 5% of my portfolio. In the past, it was always 10%, but my portfolio is way too large now to put 10% in that. And that has also to do with some learnings that I can come back later too. So with that, also my strategy is really to grow my dividends organically, ideally by about 6% annually at a 3.25% starting yield on average, which means that every time I buy a stock and you accumulate that all throughout the year, it should be around, well, not less than 3.25%. That's why I have my minimum barrier of 2.75%, because if you really go to 1.5% starting yields, you need a decade long of double-digit growth, which Broadcom and maybe Costco, like you can count them on one hand almost, yeah. And you should have been able to predict them at the time as well. So I assume that I'm not so smart and not that smart. So that's why I go more with a higher starting yield and 6% annually dividend growth. And I know it's very attractive to loosen your requirements now because everything feels so expensive. But investing in a stock that has a 40 PE multiple, think about Waste Management, that's just insane for me. I understand the quality, but a 40 multiple, that means that, you need really lots of years to earn this all back. Yeah. And that's just too much for me. Yeah. So, and this is also maybe where the question came in, like, what about buying stocks at a fair value at the beginning? Now, there's one thing that I really learned over the years, and that is that dividend safety and a decent starting yield are much more important than valuation. So if you have a dividend yield of 3%, let's say, the starting yield, and a high quality dividend safety. Now, in our premium database, we have a lot of stock cards where we also do the dividend safety assessment. Then we look, for instance, at the balance sheet. Does it have a strong balance sheet, or is it over leveraged? Has it been growing the business or not? What are the payout ratios like, and what's the commitment of the management to the dividend? And has the dividend, no, sorry, and is the business set up for growth or not? Yeah, maybe not. Maybe it's a declining business. All of this gives me a feeling for the dividend safety. In our case, we give the dividend safety score and a verdict then. But you could argue that somehow valuation is implied by that, because if you take the payout ratio and you have a 3% yield, for instance, and a payout ratio of lower than 50 or 60, there is a certain cash flow yield behind it. Yeah. You will not quickly see such a stock being 40 multiple, price to earnings. But for, what I've seen is like valuation is less important if you buy safe dividends with a for you satisfying starting yield, that meets your requirement. So that's important. So generally, I mentioned my dividends are there to grow 6% annually at the 3.25% yield on cost. I generally use a bit the Chowder version of it, the Chowder rule, but then being satisfied with a 9%. If you add those two up. I know historically it's more like 10% over time, so I hope I will also get there. But generally, for me, I'm satisfied with 9%. I'm also aiming, because that's maybe what people don't really speak a lot about. For me, my savings rate is equally important. So I really go for 50% savings rate over time. And of course, I reinvest all my dividend income. What else should I do with my dividend income today? If I have money, if I can invest all this money, then what would I spend it on if I get it in now? So it really makes no sense for me to use my dividends now. Although often when I pay a bill or something like that, I give you an example. At the expense coverage ratio, what for me means financial independence. So how much dividend income is covering all my expenses. I never need to worry really anymore about my electricity bill, my telephone bill, my food. All of that is covered already. I just don't need to worry about it anymore. My fuel, by the way, Shell, ExxonMobil, Chevron is paying my fuel. So that's really, really nice about it. But if you take this 50% savings rate and you invest it at the yield that I mentioned and the annual growth, it would take 15 to 17 years to retire early. If you need to take the dividend tax also into consideration by counting the years. So I'm now in my 11th year of dividend growth investing, and I'm currently at a 71% expense ratio. I just checked, which is really far already. So I still have, I think, 2 to 3 years left. It really depends on how lean I want to go on the financial independence or not. We know our other friend, he is now already more than 100%. I think around 130%. So everyone has a different level of comfort with it. I think I could consider maybe just straight away at 100%, because I will not stop earning money. On the other end, I don't know yet what I want to do. We spoke enough about it. It keeps on changing. So there's more, but this is just like more of like the math behind my portfolio. But this math is what everyone needs to know. This math is that I'm continuously focused on. And it has been really my guidance throughout the years. So many people, and myself as well, has the fear of missing out. I mean, I'm not from stone. Of course, I've once looked at Bitcoin. I just don't understand it. Of course, I've looked at all the tech stocks in 2020 when they all went to the moon. And, but then I all the time reminded me, okay, when I go into that investment strategy, I really don't know what I'm doing. It doesn't mean that I'm not financially literate, right? I've got my license and everything. But you can have a license, but you also build up a circle of competence around the investment strategy. Yeah, there are many people good in bond investing. There are many people good in currencies. Yeah, I just didn't make it my own to have the mental capacity to have 4 or 5 of such strategies all at once playing for me. Yeah. Um, so, but on the other hand, following this math, I want to be diversified because I know I make mistakes and I anticipate them. Over
Yeah.
time, I've been making less and less and less mistakes because I really started to understand the importance of dividend safety over valuation. Because once you go to valuation, you end up going to look in the turnaround corner. You end up looking at the beaten down stocks like Walgreens, which are rather, you could say, value traps if you only focus on those. So
Yeah.
that's why I say dividend safety for me is more important than valuation. Yeah, but of course I like them both. Yeah. Um, what's more, in my strategy, I do use tax harvesting.
Yeah.
I don't have a wealth tax here in Poland, so I can offset any gains that I have on selling shares. Now, when do I sell shares? Typically, when a dividend is cut. But what people need to know, you can still make a profit at that time,
Yeah.
because if you bought the shares long enough, and I had that with a few shares in the past, you still make a profit. And I have option income. So with the option income, I don't want to talk too much about it because I find it too advanced. I'm not recommended to others. I do it also very conservatively. I'm not like our friend Jeremy, who made like thousands and thousands and thousands on option income. I mean, hundreds of thousands, I believe, even if I remember his report correctly. I'm not like that. For me, it's like 2,000-3,000 each year. I just play a little bit with it, and that's it. So I can offset a little bit my losers, like Bayer this year, right?
Yeah.
I use that a bit for tax harvesting. What's more, honestly, ETFs, and we spoke a bit about it, don't really make a lot of sense for me as a European investor because I don't have access to the Schwab Dividend Growth SCHD ETF, and the others like the one with dividend growth, they are typically around 1% yield. The 7-8% annual dividend growth, it's not good for me. I'm also not aiming to replicate SCHD and the
Yeah.
strategy, because that means I would all the time need to every half a year switch my portfolio lot. I can't do that in a tax efficient manner. Secondly, I find it a little bit, yeah, I don't feel comfortable with that, let's say.
Yeah.
I
Yeah.
can't articulate even well why, because why wouldn't you? If SCHD, for instance, is outperforming my portfolio, yeah, and how it is, yeah. Just to give you an example of what my real results are, I had in 2022, because last year I just didn't get to making the annual report. I will do it this year again. I had a 4.5% yield on cost on acquisition. So that's far beyond above the 3.25%. That had to do with the insurers that I was buying that year. And I had a 4.38% organic dividend growth. Now, how come that this is not 6%? Really simple. I have a few high yielding companies in my portfolio that I bought earlier, like Omega Healthcare. They have not been growing their dividend, but they put a lot of weight on my dividend income. The same with Legal and General.
Yeah.
So actually, I'm probably still reaching this 9% because I've got a mix of high yield in there, but it didn't fall into that fiscal year. So overall, I'm quite satisfied with how my portfolio has been developing. But one of the biggest contributors that people really need to take into consideration is that my savings rate has been probably the biggest. Just living below your, well, not living below your means. Let's say spending less than you earn. And because I don't sacrifice on quality of life, that's really important to know for people. I still go 2-3 times per year on vacation, but I'm not a typical consumer that buys every month new clothes. I'm not, yeah. Do I have holes in my socks? Not in all of them. Let's say like that. Yeah. And the good thing is about holes in your socks, nobody sees it as long as you don't come into an environment where you need to,
Yeah.
take off your shoes. So I live relatively frugally, I guess, to the typical consumer around me. I am price sensitive to what I do, but I really enjoy life. I do a lot, so I'm not a Scrooge. And how do you get into the savings rate? It's just like give your utmost best at work. Really, it is my best advice that I can give. I see so often people starting to think once you get into this financial independence, you have the high risk of wandering around and just not having an incentive anymore. Specifically, when you go through the boring middle, you reach 50-60%, incentives may start to decline. Yeah, and that's so important to continue being focused at your work. If you can't grow your salary fast enough as per your liking, you think you're worth more, change your job. I haven't had to change jobs for a long time. I just have this fortune that I can make my own career progress. But I think this is really important, really important. And this kind of is my whole strategy, let's say.
Yeah.
And it's been quite consistent over the years. In 2020, I had a minus in organic dividend growth because of the Shell dividend cut at the time, which hurt me a lot. I was not well diversified at that time. But at the same time, I used 2020 to diversify a lot after that. So that was one of the big learnings that I had. So yeah, with the 6% dividend growth, that is for me 4% above inflation. I count on 2% inflation.
Yeah, it's quite nice actually. You spoke about it has pretty much been consistent since you started, but I think the one difference or the one key takeaway I get from listening to you now versus listening to you in 2020 when we started this podcast is you almost considered yourself a value investor in 2020. It was almost your dividend growth and value, and you have evolved now pretty much into dividend safety over valuation. Still a value investor at heart, I get it, but your mindset seems to have flipped a little bit on that. It's been quite an interesting process watching that.
Because those are my learnings from dividend cuts that we had, that I don't like, of course, but also the value traps that I invested in. And the turnarounds. And when I analyzed them, I thought like, I could see it coming, and I was just too greedy, thinking I could gain a lot from the share price development. But also not selling quick enough after a dividend cut. Thinking like because then when the dividend is cut, the issue is you quickly start thinking like this may now be a nice turnaround.
Intel is a good example.
Intel buyer.
Yeah. But I would argue sometimes you could see a dividend cut coming and you still hold on too long. Because I think Intel was probably a good example of that.
But I didn't buy Intel for the dividend, remember? I bought it straight away for the turnaround. So not doing that anymore. I learned my lessons. They cost a lot, but that's life.
When I look at your figures, I look at your savings rate, I look at your expense coverage rate. Technically, on a technical basis, you have reached what we call slim fire. You could cover all your expenses, considering you.
No, this is 70%. No.
So that's 70% of expenses, not your salary.
Of expenses. I don't look at my salary. That's not needed.
Okay.
No, I look at my expenses. Why would I look at my salary?
Maybe you just want to earn the same as what you're earning now.
But why should I earn twice as much as I need?
That's the way I look at mine. I look at what I'm earning now. I can live very, very comfortably, invest what I invest. That's what I set my goal as, to replace my current income. No,
I'm not interested in that. Why would I need twice as much money than it costs to live? You know how many years I need to add to my investment journey to get to that stage?
5.
Yeah, so why would I do that? 5 years. I mean, I hear all the time about people dropping dead here and there. That are mid-40s. Why?
Yeah. It's interesting, but do you not think then you live comfortably now? You're not a Scrooge. You said you like to enjoy yourself, but if you retire just on dividends and you're just covering your expenses, you have to make up that shortfall for the other income that you enjoy yourself on. So there'll be a shortfall somewhere along, or you can't
Why?
invest. Where's the money coming from? You're losing money somewhere along the line. You're
Where?
only, so your expenses are covered,
Yeah.
but your additional money that you invest, you won't be able to invest that anymore.
No,
Because
but why would I? I will be living off dividends.
and that's enough.
Yeah, why not?
Okay.
Yeah. Why would I need to invest at that time?
I don't
Yeah,
know.
the dividend should grow over time with this 6%. Let it be 4%, just above inflation. Then I'm just living off that.
Just
Yeah,
okay.
I mean, if I stop working, right? Let's do this hypothesis. Do you really
Yeah.
think I will not earn money? I mean, we are having the Dividend Talk premium service. Yeah, it's not like we earn a lot of money we reinvest everything into it. Yeah, but I mean, there's so many things I could do, but it would be like hobbies, and some hobbies will earn me money. Also, when I had my YouTube channel, when I was doing that, I was getting a few $100 with that each month. Like that would be more than enough for me to have a little bit of extra income to play a bit around with investing. I wouldn't know. I wouldn't know why I need more than I need.
Yeah. But you're still making up that income in other avenues. Like that income is still there, whether it's YouTube or newsletter, whatever avenue you're earning
Yeah,
from.
but I would then call that a job.
Yes, exactly.
Yeah, that would be just another job.
Yeah.
But I don't need it then. It's for me more like, how am I going to spend time? Maybe I'll stay working. Maybe I'll do charity. Maybe I'll double down on what we are doing with Dividend Talk Premium and YouTube. I don't know. My mind is all the time changing. The good thing is, if I have 100% expense coverage, which includes reservations for maintenance on the house and these kinds of things, right?
Okay.
Because that's what I'm most worried about.
Yeah.
It will it will include a fuck up fund, like this let's say half a year. You never know if you get a medical bill or something like that. It will include reservations for car, maintenance of the roof. I do that now as well. That's all in these expenses. Yeah. So why would I need more? Why would I need to go for twice as much? That makes utterly no sense to me.
But to me it does, because you have a standard of life based on the income you have now. I mean,
Now I have a standard of life based on the expenses I have now.
But to pay those expenses, you're earning a certain income.
Yeah, and 50% of that I don't need. I'm investing in the stock market for financial freedom. I don't know how you count your expenses, but for me, expenses is everything I spend on a year, including holidays, everything. So I really don't have an issue with holidays. You know me, how much I'm on holiday. Yeah, that's for me one of the most important, nicest thing that I can do in life. Yeah, seeing other countries, and I can do that on those expenses. So why would I need more? I really don't understand that. Why would I work 5 years longer? Yeah, the only thing I consider sometimes, like maybe I go for 110% or 120% to build up a margin of safety for a high inflation environment. Yeah, if we get an inflation shock again, that's the only thing. Now let me work 1-2 years longer to get there. Yeah, but the double, that would be that is for me like insane almost. So, sorry, Derek, no offense to you, but like
I don't take offense.
what do I need with all that money?
Who knows? Who knows? I don't know what you need, but I mean, you need it now, so you may need it in the future.
No, I only have this money now. Yeah, and it's a luxury that I can invest half of my money into the stock market. Yeah, but I don't need it. I could work on a job that pays half of what I earn today, and I could live the same life.
Yeah.
So why not, if the dividends pay me half of what I earn now? Yeah, and why not live on that? Why would I spend another 5 years working then?
Yeah. Look, we'll see. You'll get there soon enough. You have only a couple of years.
Yeah, and by the way, it's not 5 years set. If you grow 10% each year, it should be 7 years, 7.2 years.
Yeah.
That's a lot. That's a lot of life. Yeah, that's a lot of life. I mean, we all have our own priorities, but not for me.
Nice. No, it's a nice strategy. As I said, the only thing I could see changing is how you not switched, but your valuation metric to now dividend safety is more important, which I think is a good learning to have. But I also think you answered those two questions, by the way. I think so.
Good.
But
How
I
about
was,
yourself? Now it's your turn to
yeah,
go for your current income and not your expenses. Share it with us.
yeah, let's go, let's go. But I thought Dario's question was, I mean, I always find these really, really intriguing because is valuation important at the beginning? And I always argue at the beginning, it depends on how much money you are investing into the stock market, right? And if you're putting in a life-changing amount of money, let's say you have, I don't know, €1 million, right? And you want to put that in, I would argue, yes, valuation does matter, because how are you going to feel putting that into a company that pays a dividend and it drops 20, 30%? It's going to hurt. It's not going to feel nice. Whereas when I started, I put maybe €200 into the stock market while I was learning. So I would argue in the beginning, it depends on how much, what that risk means to you. And are you willing to lose that? Because you are going to make mistakes in the beginning, and there's no questions about that. Unless you're some super investor, which happens, you will make mistakes. So yeah, I think I agree. Focus on adding quality stocks, but how much you're investing, I think, also matters. So I started slow, eased my way into it, and got more comfortable building up to a position where now I'm comfortable investing. But yeah, I always think that it does matter how much you're actually investing and what that risk means to you. So I just wanted to answer that question straight off the bat. I have a lot of look, we're dividend growth investors, so I have a lot of similarities into how we look and manage our portfolios. I would also argue that I am probably more of a dividend investor than you in terms of the broad spectrum based on my portfolio. But at the heart of it, I started as a dividend growth investor. We do have some higher yielding positions. I'm looking at your yield on cost on this, and is that before tax or after tax?
That's the after tax, yeah.
After tax, yeah.
Net tax.
So what's quite interesting is we both think that I have a much higher dividend yielding portfolio than you, but I'm actually only 0.18% higher yield on cost after tax.
Okay,
after tax.
wait a second. I was there quoting what I invested in 2022 in a single year. That's not my portfolio yield.
Okay.
My portfolio yield at the moment is 3.67%.
Okay. So I am a little bit higher on 4.69.
My issue is like companies like Microsoft that have lifted up quite a lot, which brings the yield down.
Yeah. So I would have said, if you had asked me what do I identify as, I would say a dividend growth investor. But sometimes I actually think about that, and I think there's a mix. I do have a portion of dividend growth, but I do have a lot of high yielding positions in my portfolio. So I would say I'm probably 60 growth, maybe 40 in the high dividend camp. I do aim for at least 3% yield, and I do like to see 6 to 8% dividend growth. But if I get that from yield, if I have a 9% dividend yield, I'll only look for maybe 1% dividend growth. So I kind of add them up and mix and match the growth with the yield, because I think it's unrealistic you're going to get an end group with a 8% dividend yield and 10% growth year on year. That's kind of a bit of a unicorn. So that's what I kind of aim for. I'm kind of looking for 9 to 10% growth, and that's a mix of dividend yield and dividend growth. And whichever way that maths adds up, I'll accept it. When I look at my portfolio, the dividend growth is what I look at year on year. I don't kind of look at organic dividend growth like you did, but for the sake of this podcast, I did a quick back in a napkin kind of calculation. But my dividend growth without taking into consideration of organic has always been up near the three figures. The last 2 or 3 years, it's been 33%, 25%. It's slowing down as my portfolio gets bigger, as you would expect. I did a rough and tough calculation on organic growth. So what I did is I took everything that I invested in terms of money, reinvested, gave myself an average of 5% yield, which is close enough to my portfolio. So I have an amount that I would expect to earn, subtracted then what I've earned, and I've used that as my kind of organic growth. And it kind of works out between 8 and 12%, depending on the year, which is not bad. I don't know how accurate that is. As I said, it's rough and tough. It seems a little bit high, I must admit. But I think in some of the years, like 23, I probably invested in higher yielding stocks. So my portfolio probably more 6 or 7%. But still kind of, if I say 6% year on year, I think that's kind of achievable, which I'm quite happy to to do. If I get 6% year on year, that beats inflation, probably beats bonuses and work. So it's not a bad number. But yeah, look, I think my strategy is really, really straightforward. I have a minimum threshold that I want to get, either dividend growth and dividend yield. That's what I base my portfolio on. I said my paddy is 22%, but that's 22% of my current income, not just expenses. It's 22% of everything. I do most of my tracking on Snowball Analytics. I don't know if you've used that before, but I find it great. I have to say I have my own custom ones as well if I want to do custom calculations, but I find it really clean, easy to use, can benchmark it against other funds and so on. It's nice, but I like to keep things simple. And what I found is the more that I look at stuff, and if I'm constantly looking and tracking, the more I want to get involved in my portfolio. And sometimes this bar of soap analogy actually holds true, and I need to do less. So I try and have a little bit more of a hands-off approach unless there's some news or something coming up. I'm trying to practice that. It's not always easy when you have social media, I have to say, but that's what I want to try to practice, especially a little bit more in the coming years. I think I've done a better job this year than I had in the previous years, but I want to try and do my homework up front, trust my conviction, and just let it play out and see how it goes. Like, and Unilever might be an example where I sold it too early. We'll see, but just as an example. You mentioned your savings rate earlier. I do specify how much I invest every month, and I have on the past. So I'm not going to give my exact savings rate, or people will work out what I earn, but it's roughly between 30 and 46% of my income. And that's all invested. I do have additional savings then in fund for myself and my wife, where we go on holidays, home improvements, maintenance as well. That's on top of that. But just investment wise, it's between 30 and 46%. Sometimes I invest a little bit more. So it's quite interesting. I've been talking to my wife over the last couple of months, and one big decision we have coming up, which could potentially impact how my investments go, is we're thinking about moving house. Okay, moving to a bigger house or renovating. I'm not overly keen. It's not overly keen, but I understand my wife's point of view. And look, it's a partnership, so we have to give and take. My main way is to figure out how I can do that without reducing my investment rate. I would call this my non-negotiable, and this is what we're always talking about. So I don't want to push out my retirement date. So stay tuned on how we navigate that, because I'll talk about it as we progress through that. But these are big life decisions that happen. It's easy to sit here and say, invest this amount a month for 12, 13, 14 years and you'll be financially free. But decisions come up along the way. You have families, you have kids, different areas and schools that you have to be a little bit flexible about. So that's one big decision that we have coming up, and how we navigate that could potentially impact my investments, and maybe it will push out my date. But I will try my best not to do that. But yeah, look, I don't think there's anything new. I try to keep my strategy as simple as possible. I have a lot of closed-end funds, which is my higher yielding stuff, managed by portfolio managers, and then I have some companies. So simple as possible, I think, is the best way, and try not to handle it like a bar soap.
So I mean, we know each other quite well, right? So it's also nice to see how you've been evolving, and your portfolio growth has been quite astonishing. If you look at the dividend growth as well, and it doesn't matter how you come there, you have a middle class income. Yeah, you live your life, you're able to save money, and you're at a dividend income already that pays quite a significant amount of bills.
Yeah,
now already. Yeah, and you're in your 30s, right?
Yeah.
So look at it. You're way ahead of most people in society. It's amazing.
But I consider myself similar to you in that respect, is that I'm not a typical consumer. I'm not going to go and buy new clothes or the latest Marcons every month. I mean, my wife kills me. I get clothes as presents for Christmas, and I'm happy with that. I mean,
yeah, exactly.
It doesn't bother me. I'm not your typical consumer, and I think that's. I mean, I get a lot of people starting to come to me for advice on different things, and investing or saving. Not even investing; they want to save first, which I always encourage. Before you invest, you should be able to save. And I've sat down with a couple of family members and a couple of people, and you're going through bills, and you're like, do you really need this? And honestly, they will always argue that they do. Right. And it could be like clothes. Oh, I need a new wardrobe. I need new this. It's summertime. You're like going, okay, I'm not going to win here. So if you need that, you need that. But I don't think you do. But I think that's where consumerism comes in. And if you can control that, as you said, manage your savings rate, see what's really important to you, and do that.
But let's be fair. We need the majority of people to consume based on the holdings in our portfolio.
Yes. Ignore what I said. Spend.
Yeah, no, we benefit a lot from the spending habits of the people around us. Yeah, if people wouldn't buy all this stuff all the time, we wouldn't be getting so many dividends in.
Yeah. No, it's completely true. But you can see how people are wrapped up in consumerism. And look, I'm not immune to it. There's obviously things that I impulse buy sometimes, but I just find as a whole, I'm not as impulsive with
exactly. And I must say that dividend investing has helped me with this. Yeah. And it's also quite cheap. I mean, dividend investing, you can download the annual report for free online, and I'm an evening entertained. Forget about the booze and the hookers. I don't need them. Give me the Van der Velde annual report from this Belgium underwear company, and I'm satisfied for a week.
Yeah, I mean, I can't argue with that, but I think it's a good hobby in that, and it teaches you discipline. Once you have that discipline, it becomes a lot. Like, I never feel like I'm missing. I don't know about you.
You start looking at the world through different glasses. First of all, from dividend growth investing, you learn so much about the world because all the CEOs are commenting on that. You also start reading a bit of stock market news, and the stock market news cares about the world because it hits the investment portfolios. So you learn a lot from that, but also. Yeah, you start doing the math all the time. You think that's how it was for me. Like, okay, if I don't buy this thing, let's say this for €500, I could invest that.
Yeah.
And then at a 10% annual growth, wow, in 7.2 years, that's 1,000. Another 7.2 years, so in 14.4 years, this is 2,000. And then in 21.6 years, this is 4,000. And then it's like blowing your mind. Yeah. And then you start thinking how much years I still have ahead of me in my life. And you think like, whoa, this €500, I'm buying something for €10,000 or something like that. Yeah.
I don't usually think like that, but when I went to Vegas and we went over, and it was back in August, and I remember I was close to the 100K mark in my portfolio, and I could not help but think, over that, especially as the latter stage of the holidays, I don't spend this in this bar. I mean, it was $100 for 2 or 3 drinks. It's crazy, right? But if I don't spend this in this bar, I can put that into my portfolio and push it over 100K. And honestly, it was so in the back of my mind. And when I came back, I put all that excess money back in, and it helped push me above. And there's such a feeling I got from that. But go back 10 years, and I would have been like, YOLO, spend.
Exactly.
But, so it was, it's quite funny how it changes you a little bit in your spending habits.
Awesome. Well, hey, I hope we answered this question from both Dario and Tobias well enough. Let's go to some of the other listeners' questions.
Yes, let's do it. Tomas is first, and he was triggered by you mentioning the Succession series last week. But he's asking, do you know any other movie investment related?
Well, The Wolf of Wall Street is really epic. Wall Street itself is also really epic. You've got, of course, the Big Short that he mentions. Those are really the better ones.
The main ones, yeah.
Did you start watching Succession?
I haven't yet. No, I haven't yet. I haven't. But I will over the Christmas period, because when I watch something, I like to binge, and I'll just keep watching.
Good.
I will watch.
There goes your Christmas.
Here goes my Christmas. Gordon has said you recently said that with closed-end funds, you're buying management risk. Aren't you also doing that when you buy a single stock? So he's thinking of poor management decisions from Bayer buying Monsanto, etc.
Yeah, and this is another case where it proves that our listeners are more clever than I am.
Yes, it's quite funny, because we say, I feel like Kramer sometimes. Don't they? Sometimes you talk about so much and you say things, and then it comes back
Yeah,
to bite you
because
in the ass.
you're in a line of thought at that time, and
Yeah,
you don't sit down and start looking at from each and every angle for an hour, because then of course you may come to different conclusions. But that's why we always say dividend talk is a bit like pub talk.
yeah, yeah. But I mean, look, it's an excellent point and also correct. No matter what you invest in, there's management.
Yeah, and he didn't even
Yes,
say, like, because that's what I probably would have asked, is like, um, with individual stock picking, you are yourself as the
yes,
assessor also
yes,
a risk. Yeah.
yeah, yeah.
And I've
And
made
we,
my share of mistakes over the years. So Tupperware is one example.
yeah, yeah. Walgreens is one of mine.
Yeah.
W. Scott, I purchased an Aristocrat that is now down 30%. It's got higher financing rates and consumer belt tightening, which is impacting its sales. We don't know what this Aristocrat is, but he's thinking of selling on January the 1st, waiting 35 days and buying shares back. Am I a dumbass?
I think not. If you have a conviction in this one, not. Really simple. This is what tax harvesting allows you to do. Yeah.
Yeah, yeah,
Yeah, I think it's good, because what he can do is then he can offset the losses against his gains. And I think this, how is it called? The shill wash rule, that you need to wait 30 or more days before you can buy back again. I think it's quite clever. If you're convinced about this one, why not? If you
yeah.
have the discipline also to buy it back. I did it once and then I forgot about it because I saw something nicer.
Yeah, I mean, look,
Yeah.
say we don't know much about the Aristocrat, but there's pros and cons.
Yeah.
If you're already thinking of it, you probably should do it. That's
Mhm.
Ar Arkia has asked about dividend growth investing. It needs active management. It's not passive. It's not as passive as everybody thinks, but it needs active management. How would you approach this when you get older and might no longer desire to actively manage your portfolio?
So I don't see that happening. I think I really felt my life passion in this simulation that I'm living. But let's say that I would no longer desire to do that. There's actually another question behind it where I haven't made up my mind yet. How to leave your portfolio behind to someone else that doesn't have that passion? That's more the
Yes.
question that's in my head. I
Yeah.
haven't figured that out yet.
Yeah, it's so tough. I think we spoke about that in bits and pieces on the show, and it's a hard one. And do you know what? It's probably something I'll need to get proper financial advice on, and how we manage that money tax effectively if somebody wants to move it out of my portfolio into
Yeah.
whatever they prefer. But it's a interesting question. But I think we have plenty of examples of investors, and we've spoke to a few on the podcast who are now retired, who still have that passion, who still love going through
Yeah.
individual companies. And honestly, how I feel now, I don't think that will change. I can't see that happening.
No, and the issue is here for Europe is first that we don't really have an ETF that we can throw it in as an equivalent. That's really a big issue.
Yeah.
Because our strategy depends on the income from the portfolio. So if you want to go to a more passive version, you need to generate at least the same income.
Yeah.
And that's where we really had a roadblock if you want to stay in the dividend investing philosophy.
Or you're going looking at annuities or other different options to keep that.
Yeah, exactly. Yeah.
Kieran has asked us about real estate investment trusts outside of America. So how do you change your analysis when you're investing or checking those out?
Yeah, and he's looking at AFFO, right? Adjusted funds from operations. So let's forget about the A. Let's look at funds from operations as a bottom line figure. They don't report it, but it's so easy to calculate. You just go to their annual report, you take the net income, you add back depreciation, amortization, and you deduct the gains on sale of property, let's say. If you do this for 2023, you will see that the net income was 200.2 million, depreciation and amortization was 1.3 million. I think the annual report first says 2.1 million because there's also leases in there. But if you search on depreciation, you will find the real number, 1.3 million.
Yeah.
And they had gains on sale of property of 93.8 million. So if you do the math here, you have funds from operations of 107.8 million on a market cap of 1.5 billion today. That is based on 2023 numbers, that's a multiple of 13.9 price to funds from operations. It's quite easy to calculate this, Kieran. So that's what I would suggest. Just take the FFO and calculate it yourself if you're interested. It really takes 1-2 minutes if you know the formula.
Yeah, nice. Brian has said, a few weeks ago, you guys dismissed share buybacks as a trick to allow management to look good. But wouldn't you agree that buybacks can be valuable to the company and investors in a number of ways? And he's listed a couple of ways.
Yeah, we spoke multiple times about buybacks, and maybe we were in a certain line of thought. My frustration with buybacks is that most companies, from what I see, they're just buying back shares, whatever the price. Yeah, and this props their bonus up effectively, but may not be in the interest of the shareholder.
Yes.
Yeah? And that's where I have an issue. I really much like the Warren Buffett approach. He just says like, hey, above the share price, we will not buy back. Below the share price, we feel that the company is undervalued and we buy back shares. That's for me like buying back shares well done. I really like also how, for instance, HP Inc. is doing it, a company that I own. Very clear about their buyback policy as well. Ahold Delhaize as well. They just buy for 1 billion a year, and this company has never reached the stratosphere of overvaluation or something like that. Yeah. I do believe they will continue to buy 1 billion back a year if they will be trading at 50 euros instead of 30 euros, because that's how they kind of do it. I also liked how Evolution is doing it. Evolution really turned up the buyback machine when it dropped under 1,000 Swedish crowns. But there are so many companies that have been buying back shares at a 40 multiple. And then when the stock crashes because earnings crashes, they stop the buyback machine. And while at that time, they could have had a really nice, strong balance sheet, let's say, and at 50% of the price, they could have been buying back all those shares, by leveraging up at that time. But no, they were leveraging up at the top. And Nestle is an example of this one.
Yes. Yeah.
Nestle has been leveraging up the balance sheet a lot to buy back shares, and now the shares crash. Here we are. Yeah. So that's my issue with many companies, not so much buybacks. I truly believe that buybacks is a really strong element, a strong decision for capital allocation, but done well. That's where I more would like to see. And not every company in my portfolio does it well.
Yeah, and that's the key, isn't it? Like with all metrics and all.
But why is Microsoft buying back shares now, or Apple?
Why are they, or why are they?
Yeah. Why is Microsoft buying back shares at those high yields, or ASML? Why? That may be better example. Why is ASML buying back shares at such a high multiple? I don't understand it. Yeah, just just put more and more cash on your balance sheet. Buy high yield bonds, whatever you need, or something like that, if you want to make a return on it. But for me, it is to spend so much money for a 0.3% buyback yield or a 0.5% buyback yield, then just give special dividends to the people.
Exactly. Daniel said, to follow up on the last episode, have you ever tried to reach out to NN Group Investor Relations and ask why the lack of transparency between
not yet
individual investors and institutional?
Yeah. Daniel, if you have time, because he asked, shall we try it? Yes, please try it. I've been just so soaked with on the web. I said too much on my work plate and outside activities, but yeah, we should really do it and try it, Daniel. That at least would save me one email of time. I would love to hear the answer.
Vladimir has asked about the euro and the dollar. Obviously, with the euro hitting new lows versus the dollar, is it time to shift focus towards European stocks? I mean, I think we get asked about currency a lot of the times on the show, and we never know if we're going to hit new lows or if it's the bottom. I try and keep a balanced approach between European and US. I think I can't remember, it's 40-60 or 50-50. I think you commented even last week, I shifted more European, and now it's more US. It just depends on that. But yeah, look, I can see it. It absolutely makes sense with euro hitting lows. Maybe it is a good time, and Siemens increased the dividend a couple of weeks ago. I mean, we've got plenty of good companies in Europe that we can focus on. So I'm never going to say no to focusing on European stocks. Hens de Jong, you're located in Poland, and they seem to do great in a more regulated and taxed EU environment. Your investments will grow a lot faster due to lower taxes than in the Netherlands. Do you expect this to change in the future? Such a tough question.
So we have 19% tax here on both dividends and capital gains. It's probably indeed. So where I earn money compared to the Netherlands, we don't have a wealth tax here. So I don't pay tax on my net worth. I don't pay tax on my house. We pay some tax on the house, which is more like for the land. Yeah, but this is maybe €100 a year. Yeah, but we don't pay ownership tax or something like that, like in the Netherlands, where every month you're just sending money to the government. Yeah, which is really a pain for many people, specifically later in life, because then you're eating up your own house effectively, right? If you don't make any money with your house. Yeah, so we don't have that here. If I expect to change this in the future, who knows? It's an emerging country. At a certain moment, I think all these countries follow a similar path. Yeah, now it's a boom of economic growth. When that stalls, the government will probably still want to finance a lot of stuff, whether it makes sense or not, and then they will need to maybe raise taxes, maybe introduce a wealth tax because other countries are doing it. Yeah, like if those are an example, as if those would be an example. So let's say that I enjoy it for now like this, because what the issue is, if Poland would raise the taxes now, it would kill the whole lower class straight away. So there is not in Western Europe, there's more luxury at the lower class, not here. So if they would raise taxes, it would kill the whole lower class, and it would stop investment. So it would be really, really bad to do that, and that's typical in an emerging country. So, but later on, yeah, once people get more used to a certain standard of living, taxes will have to increase, and then lowering taxes will be really hard. Yeah. And if then economy starts to stall, that's where you get this deathly crossover that you see in some Western European countries. But I think it goes. For me, it's kind of a normal trend for developing economies.
We got a question from Remy. Could you please share how you value insurers like Legal and General and NN Group?
Operational cash flow and pay attention to the solvency ratio.
Lewis has asked us about CVS. Do you think they will become the next Walgreens Boots Alliance?
I have no clue. I don't follow CVS.
It's hard to know. What I do know is Dividend Wave for a long time was definitely a lot more bullish on CVS, and they seem to have better management than Walgreens at that time. They took a bit of a different path, but it's hard to get a feeling for these companies when we're not based in the US. So I think maybe some of our US friends could answer that a little bit easier than we can. Centrino has asked us why not invest in renewable energy stocks like CWEN and BEP, which are undervalued and have a nice dividend growth. I don't know who CWEN is, but I was looking at BEP actually. They're part of the Brookfield group, but I haven't pulled the trigger on them yet. I do have a closed-end fund or an investment trust in solar, and I also have one in wind as well. So I don't want too many. I think 2 or 3 in that field is enough. But I do like the Brookfield companies. I do have BAM, so maybe I will take another look at that one. Tim Ainley has asked about your thoughts on Texas Instruments and their journey of capital reinvestment.
I think they're according to plan. Yes, so I looked up again in August. They had an off-cycle update on this, and everything seems to go according to plan. So expect it to be in 2026 that let's say the capex should be done, and then it should be more flowing in line of revenue. So now they are having like, what is it? 5 billion or something like that, and then it will go back to approximately 1.5 to 2 billion. So we should be good by then.
Okay, nice. Okay, and then the last question came from Pele. What a great name. Any opinion on, there's two ticker symbols, LB or TPL, and I believe TPL is Texas Pacific Land Corp and LB is Lambridge. And look, honestly, I don't know what they're into real estate or land somewhere in the US, but I don't know anything about it.
Well, Lambridge is, I mean, we need to give kudos to the guy. Who was it again? He was here to talk about macro. He was on the podcast. The guy from Netherlands.
The name's gone for me. I can't remember.
Yeah, he's been investing a lot in Lambridge and he earned a lot of money with that. So he made a really, really great call there. And yeah, he's I believe it was Lambridge that he was investing in, and he did really well with that.
The dividend yield on both is less than 1%. It's 0.66.
Yeah, but look at where the share price was a year ago.
Yeah, of course.
Yeah,
of course.
And the yield was also different.
Yeah.
It was Leo Nelissen.
Yes,
on the podcast.
Yes, perfect. Yeah. Awesome. That's it. That's it for all the questions. Thanks again to everyone for all the questions. We hope you enjoyed this podcast, and we will see you for one more before Christmas. So we'll be recording next week.
Yes.
Our Christmas special. So we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.